one set of stocks that we wanted to discuss. We have begun to see a steady, even if slow, rise in crude prices. So where does that leave stocks like BPCL, HPCL, IOC, all the basically the oil and gas stocks? That's the question we're asking Jal Irani, oil and gas analyst at Edelweiss Financial Services. Morning, Jal. Well, you know, it's a stellar run that we have seen for BPCL in particular, and in addition, HPCL as well. Do you think now that we have started to see this turnaround in crude prices, BPCL and HPCL will stop giving these stellar returns?
Well, firstly, what we need to understand is that there is very significant and structural changes which have taken place, which which actually is enhancing the earnings and valuations of these companies. In fact, both of them very significantly. In a similar situation, and I'll come back to this, in a similar situation during the 2002-2004 period, when we did actually have deregulation, these stocks had gone up between 400 to 800%. And in fact, structural reforms at that stage didn't even stick. Now, why exactly, I mean, what are these structural reforms? Essentially, we've had petrol decontrol about 2 years back. More importantly, diesel decontrol, which despite oil prices going up, again, that has remained. In fact, we saw 2 significant hikes of 3 rupees a litre, and there was absolutely no opposition. So the market believes that actually this decontrol is here to stay. And in fact, what is not significantly publicized as yet is that LPG reforms are going very strong. 90% or so of the people have moved over to the direct bank transfer, and that potentially is going to save another 10,000 crores of subsidies. So what this all means to the bottom line of these companies is that the profits are actually poised to double over the next 3 years or so. And in fact, the valuations, even after running so strongly, are not very expensive. They are single-digit or barely double-digit versus the market at 15 times. So for all these reasons, we think that while these stocks have already run hard, we feel that actually there is a significantly greater run yet to come.
Okay. Jal, hi, morning. So what is your estimate as far as GRMs are concerned for, say, a company like BPCL? Last quarter, I think they did GRMs to the tune of around $8 per barrel or so. How much do you think it could rise to in, say, the next couple of quarters?
We are looking at a GRM scenario which is reasonably benign. We're not expecting major leaps and bounds there. The point here is that we are not taking a cyclical call on these companies. We're taking a very structural shift. So this has really got nothing to do with gross refining margins. This has got to do with retail margins. Okay. Retail margins on diesel essentially were 70 paise a litre, which now is 1 rupee 20 paise a litre. Okay. And all studies of global markets such as Korea and US suggest that retail margins in the longer term should be in excess of 1 rupee 60 paise a litre, and in fact even in excess of 2 rupees a litre. Now, retailing as a business, these companies are bigger in retailing than they're actually in refining, and it's the retail margins which are going to drive profits up significantly. Also, the sharp fall in subsidy burden by 80% actually halves working capital requirements and increases or reduces the interest burden by 30%. So that has a multiple effect.
Okay. Well, you know, actually, BPCL, HP and IOC have been also outperformers over the past 1 year. BPCL in particular, getting pretty close to your target price. I think your BPCL target price is 935 rupees. It's already at 845. So, you know, these stocks have seen decent gains. What hasn't seen too much of gains are the gas stocks, ONGC and GAIL on 2 sides of that sector. What's your view on, let's start with ONGC first.
A minor correction. BPCL, our target price is 1,030.
Okay.
We perhaps are the highest on the street. sorry, your question was more,
yeah, more
on
the gas stocks. ONGC first.
Well, those stocks haven't performed very well, and especially GAIL, we've recently upgraded from an underperformer to a hold recommendation. I think the worst is over for these stocks because these stocks are hugely leveraged to oil prices, including GAIL, because its input costs, essentially, in its largest business, which is petrochemicals, is fixed. So it gets that input cost doesn't change dramatically, while its product price, which is petrochemicals, is linked to international prices. And as a result, we think the worst is over for them, for GAIL in this case, but the upside also at the moment would be limited.
Okay.
Now, ONGC as well, it would seem that below a $60 per barrel oil price, or roughly about $60 oil price, it would seem that the subsidy burden, I mean, they may not have to bear any subsidy burden or very little, if at all. Now, that makes them very sensitive to oil prices, and similarly, we think that oil in the near term, oil is not in the longer term going to go down dramatically. So fundamentally, we see very modest growth for both of them in terms of volumes. But I think from an operational leverage perspective, the worst is over for these companies.
Okay. So when you say the worst is over for ONGC, the stock price has fallen almost, about 27% or so in the last 1 year. From here on, where do you think the stock could go?
Well, we have a whole recommendation. So at the moment, we don't think that it is going to move within a 10% band in either direction. It's not going to move significantly.
All right, Jal, we'll leave it at that. Thank you very much for joining us with that
Thank you
bunch
much.
of oil and gas stocks that you cover.